Hook. You're lying in bed. It's 2 a.m. The room is dark except for the blue glow of your phone screen. You open your banking app. You refresh the page. And there it is, the number. Maybe it's 10,000, maybe it's 50. Whatever your finish line was, you finally hit it. Your heart does that little jump. You did it. You grind it. You skipped the lattes. You ate rice for a month. And you actually saved the money. You feel like you won the game. You close the app, smile at the ceiling, and drift off thinking you're finally safe. But here's the catch. While you were sleeping, the rules changed. You wake up 6 months later. You go to buy the same groceries, fill the same gas tank, pay the same rent, and suddenly that number doesn't buy what it used to. The finish line moved. You didn't lose the money, but you lost the power. You think you're financially stable because you have cash in the bank, but the system is tuned so that cash melts like ice cream in the sun. Hitting the number feels like a win, but for most people, that's exactly when they start losing. Problem deep dive. Let's be clear, you're not broken. Almost everyone thinks saving cash in a bank is the safest thing on earth. It's what your parents told you. It's what the bank tells you with their free toaster and friendly smiles. But keeping all your money in a savings account is like running on a treadmill that's slowly speeding up. You're running hard, you're sweating, you're doing everything right, but you're actually moving backward relative to the cost of living. Visual cue. Animated roller coaster going up, then plummeting. Think of it like a roller coaster. You climb the hill. That's the saving phase. It's hard work. But once you hit the top, most people think the ride is over. They park the cart. But the ride doesn't stop. Inflation is the gravity pulling you down. If you aren't moving forward faster than gravity pulls you back, you're dropping. Statistics show that emergency funds are great, but long-term cash savings, they're a guaranteed loss in purchasing power. You feel safe because the number on the screen doesn't go down, but the price of everything around you goes up. That's the trap. You're protecting the digits, but you're sacrificing the freedom those digits were supposed to buy. Intro and disclaimer. My name is Ted. I'm obsessed with how money actually works, not how banks wish it worked. I'm here to cut through the noise so you don't end up working forever for money that buys less every year. Now, quick disclaimer, this is education and entertainment only, not financial advice. I'm not an advisor, I'm just the guy pointing out the traps. Consult a pro before making big moves, but do yourself a favor and listen closely, because what you're about to hear might save your future self a lot of stress. Explanation of changes. So why is keeping money in the bank actually wrong for long-term stability? It comes down to 2 phases. Phase 1 is the grind. This is where you are right now. You're trying to accumulate capital. You need cash for emergencies, sure, but Phase 2 is where everyone messes up. Phase 2 is preservation and growth. When you stay in Phase 1 mode forever, just hoarding cash, you fall into psychological traps. You feel rewarded for being scarce. You think, I saved this, I shouldn't risk it. But the risk isn't in investing. The risk is in doing nothing. The system incentives are stacked against you. Banks pay you 0.01% interest sometimes, while inflation runs at 3%, 4%, or higher. They take your money, lend it out at 7%, and give you crumbs. It's the rich tax no one calls a tax. Visual cue. Graph showing inflation line crossing over savings interest line. And here's the emotional hook. After years of scarcity, spending feels dangerous, but keeping money static feels safe. It's not. When you hit that savings milestone, your brain wants to relax. It wants to buy the upgrade. Or it wants to hide the money under the mattress. Both are mistakes. The goal isn't to collect money, it's to collect options. Cash in a bank loses optionality over time. You need your money to work as hard as you did to earn it. If you don't shift from saving to allocating, you're just volunteering to be poorer tomorrow. Math and data backing. Let's look at the math, because numbers don't lie, even if banks do. If you have $10,000 in a standard savings account earning 0.5% interest and inflation is running at 3%, which is conservative, you're losing 2.5% of your purchasing power every single year. In 10 years, that $10,000 still looks like $10,000 on your screen, but it will only buy what $7,800 buys today. Visual cue. Bar graph shrinking over time, labeled purchasing power. Compare that to a boring, diversified index fund that averages 7% growth after inflation. That same $10,000 could double in real value in about 10 years. Vanguard reports and Fed surveys consistently show that investor behavior gaps cost people more than fees do. People stay in cash because it feels safe, but safe cash is risky money. The data proves that boring long-term growth beats hoard in cash every single time. You don't need to pick winning stocks, you just need to not lose to inflation. Contrasting stories. Let's talk about John and Josh. Both of them hit a $20,000 savings milestone last year. They worked hard. They were proud. John decided banks were safe. He kept the money in a high-yield savings account because he heard it was smart. He felt secure. But then his car broke down, and inflation hit his rent. He had to dip into the principal. He's back to square one, feeling like saving is impossible. Visual cue. Split screen. John looking stressed. Josh looking relaxed. Josh took a different path. He kept 3 months of expenses in the bank for emergencies. That's smart. But the rest, he allocated it. He put it into assets that grow. He didn't touch it. When his car broke down, he didn't panic because his emergency fund covered it, and his growth layer kept working. Josh isn't richer because he makes more money. He's richer because he understood that money is a worker, not a trophy. John is stuck on the treadmill. Josh bought the gym. One drifted back into scarcity. The other set rules that built a floor and a ceiling for his freedom. Actionable playbook and close. So, what do you actually do? Here's the playbook. Don't overcomplicate it. Number 1, set 6 months of expenses in cash. That's for survival, not for growth. Number 2, build a growth layer. Anything above that floor needs to be invested in something that outpaces inflation. Low-cost index funds, bonds, whatever fits your risk, but it must grow. Number 3, be suspicious of sales. When you feel rich because you see a big number, wait for 48 hours before spending. Number 4, automate the shift. Move money from savings to investments automatically so you don't have to decide every month. Visual cue. Checklist appearing on screen with check marks. Money isn't about the number. It's about what the number lets you say no to. It's about options. It's about freedom. The bank wants you to think safety means stillness, but in economics, stillness is decay. The real catch is this: protect your first number like it's the floor, not the finish line. Don't let your hard work melt away while you sleep. Make your money work so you don't have to.